The Bank of Canada's September 6, 2023 rate pause will not reignite Canada's housing market. Today, we delve into the world of Canada's housing market, exploring the implications of recent decisions made by the Bank of Canada on interest rates. In an article published by the Canadian Press on September 7, 2023, titled "Interest Rate Hikes Might Be Over But Don't Expect Housing Market to Flare Up," BMO. Author Ritika Dubey provides insights into the current state of the Canadian housing market and what might lie ahead. The article opens by highlighting the recent decision by the Bank of Canada to keep its key interest rate unchanged. While this decision may lead some to anticipate a resurgence in the housing market, one economist believes otherwise. Enter Robert Kavchich, a senior economist with BMO Capital Markets. According to Kavchich, it's unlikely that we'll see a housing market flare up similar to what occurred in the spring. Despite the Bank of Canada's pause on interest rate hikes, Kavchich outlines several key factors contributing to this restrained market sentiment. First, he points to a softer job market. Second, an increase in new property listings has added to the complexity of the housing landscape. And third, a more restrictive mortgage market has made it tougher for prospective buyers to enter the market. One of the critical factors Kavchich emphasizes is the disparity in mortgage rates. Even with the interest rate pause, the current lowest available mortgage rates are approximately 1 percentage point higher than those seen during the spring. This disparity plays a significant role in shaping the housing market's trajectory. To understand the present, Kavchich takes us back to earlier in the year when the market was bracing for a potential recession. During this time, the bond market experienced a rally, leading to lowered yields. These factors, combined with the Bank of Canada's pause on interest rate hikes, created a perfect storm that heated up the real estate sector. However, as Kavchich highlights, the situation has evolved. We are not witnessing the same sense of relief in the housing market as we did before. Kavchich stresses that the decisions made by the Bank of Canada regarding interest rates have a direct impact on the sentiment among homebuyers and sellers. He notes that the moment the Bank of Canada began raising interest rates, the housing market went exceptionally quiet. Conversely, when the central bank paused its rate hikes in the spring, the market experienced a significant boost. While Kavchich suggests that the Bank of Canada's recent decision might provide a psychological boost to potential buyers, he cautions that it won't have the same powerful effect as before. Why? Because the financing landscape has changed, and the cost of borrowing is no longer as cheap as it was in the spring. To further gauge market sentiment, the article references a report from Max released on September 4, 2023. The report reveals that 33% of Canadians interested in buying or selling property in the next 12 months are adopting a wait-and-see approach concerning interest rates. On the other hand, approximately half of the respondents stated that their decision to buy or sell a home would remain unaffected by changes in central bank interest rates. Looking ahead, Kavchich predicts that we can expect to see high volumes of new property listings this fall. However, he also anticipates that prices will continue to stagnate, which might persist throughout the remainder of 2023 and well into 2024. This stagnation is attributed to the housing market grappling with the challenges of high interest rates and a limited supply of homes for sale. While the Bank of Canada's decision to pause interest rate hikes might give potential buyers a psychological boost, the Canadian housing market is not expected to experience a resurgence similar to the spring. A range of factors, including higher mortgage rates and economic conditions, are shaping this outlook, which is projected to continue affecting the market dynamics well into the coming year. It's a situation where psychology and economics intersect, painting a nuanced picture of Canada's real estate landscape. Certainly, there are several key factors contributing to why the Bank of Canada's rate pause in September is not expected to have the same effect as the one earlier in the year. Here are some additional reasons. Changed economic landscape. The economic landscape has evolved since the earlier rate pause. In the spring, there were more uncertainties about a potential recession, leading to a different market response to the rate pause. However, the economic conditions have since changed, leading to a different market sentiment. Market saturation. The earlier rate pause created a surge in demand as many potential buyers entered the market, causing a supply-demand imbalance that drove up prices. With many of those buyers having already made their purchases, the market may be saturated with fewer potential buyers to stimulate further demand. Limited mortgage rate relief. As mentioned in the article, even with the rate pause, mortgage rates remain higher than what they were in the spring. This means that the cost of borrowing is still relatively high, reducing the attractiveness of homeownership and slowing down the market's response. Uncertainty and caution. Buyers and sellers may now approach the market with caution due to uncertainty about the future. Economic conditions can change, and potential buyers might be concerned about making significant financial commitments when there's lingering uncertainty. Mortgage market changes. The mortgage market has become more restrictive, making it harder for some potential buyers to qualify for loans. This factor can act as a deterrent for those considering entering the housing market. Lack of urgency. Earlier in the year, the rate pause created a sense of urgency among buyers who feared missing out on lower rates. With rates remaining relatively high, there may not be the same urgency to make a move in the market. Government policies. Government policies and regulations related to the housing market can also impact its dynamics. Changes in policies, such as stricter lending criteria or tax measures, can influence buyer behavior and market conditions. Market correction. The earlier surge in demand and prices might have led to an overheated market. A period of correction or stabilization may be necessary before the market experiences another significant upswing. Psychological factors. Market sentiment can be heavily influenced by psychological factors. If potential buyers and sellers perceive that the earlier surge was an anomaly or unsustainable, they may be more cautious in their approach. Regional variations. The impact of the rate pause can vary by region. Some areas may continue to experience growth in the housing market, while others might see a more subdued response, depending on local economic conditions and housing supply. In summary, the efficacy of a central bank's rate pause in stimulating the housing market can be influenced by a multitude of factors, including changes in economic conditions, market saturation, mortgage rate levels, government policies, and psychological factors. These factors combined can create a different market response compared to earlier rate pauses. What do you think? Will the housing market flare up again due to the Bank of Canada's rate pause? Or is it already too late for many mortgage holders struggling with higher mortgage payments and increased debts? Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.